In today's lesson, we will discuss credit card use and debt management. Let's get started. So what is credit? In general, credit is an alternative way for you to purchase consumer goods or services. Examples of credit include credit cards, automobile loans, home equity loans, student loans, and many others. Credit gives you the flexibility of enjoying the goods or services right now with the ability to pay it back later. There are different types of credit cards such as bank credit cards, retail credit cards, and travel and entertainment cards. Bank credit cards are issued by financial institutions like MasterCard, Visa, and Discover. Features of bank credit cards include a line of credit dependent upon the applicant's financial status and the ability to pay, cash advances, and balance transfers, other services or rebates, and interest rates and fees. Retail credit cards are the second largest category. They are usually issued from department stores and retail stores like Sears, JCPenney, and Home Depot. These cards are issued to build loyalty and have a preset credit limit. Using a credit card has many advantages such as flexibility, emergency cash resources, online purchases, and reward or perk programs. The most significant disadvantage of using credit cards is that it is a very expensive way to borrow. You are also increasing the possibility of overspending. It also involves risk of fraud and identity theft. In addition to the disadvantages of credit cards, there are several costs associated with using a credit card. These costs include annual fees, transaction fees, late payment fees, over-the-limit fees, balance transfer fees, and foreign transaction fees. The variation of all of these fees depend on the type of credit card and the provider of the credit card. It is very important for you to be aware of your credit card's contract terms in order to use it to its full potential. Some terms you will find in the contract are transaction date, billing date, due date, grace period, credit limit, minimum payment, and cash advance. The transaction date is the date on which you make a credit purchase. It helps you to keep a record of all your purchases so you can better manage your budget. The billing date is the last day of the billing cycle, which determines how much you have to pay for that month. The due date is the date in which payment must be received for that billing cycle. The grace period is the time between new charges and the due date. The credit limit or credit line is the maximum amount you can borrow. It usually starts low and increases with responsible card usage. The minimum payment is the required amount you must pay each month to remain in good standing. It is critical for you to have good credit habits and remain in good standing. Last, a cash advance is borrowing cash from the credit card instead of buying on credit. Cash advances are usually subject to different repayment terms, leading to higher costs. One debt management ratio that is often used to assess the amount of credit you can handle is the debt safety ratio. The debt safety ratio is used to decide how much credit you should borrow. It is calculated by dividing monthly consumer credit obligations by monthly take-home pay. Monthly consumer credit payments, excluding mortgage, should not exceed 20% of your monthly net income. To avoid credit card trouble, you should use discipline when purchasing, reduce number of cards, be selective in accepting pre-approved credit, pay more than the minimum if you can, pay off cards with the highest finance charges first, and transfer balances to the card with the lowest rate. Credit card fraud is one of the risks associated with using a credit card. You need to be very careful with your personal information related to credit card use. it is important to destroy old cards, shred old statements, and report lost or stolen cards immediately. Keeping track of your credit is very important in debt management. You can use the 5 C's to help you track your credit. In addition to the 5 C's, reducing outstanding debt is another efficient way to manage your debt. You can also consider these methods to manage your debt.